The financial world just witnessed something that many thought was impossible. JP Morgan Chase, one of the largest and most powerful banks in the world, has reportedly missed a margin call. Now, before you think this is just another clickbait headline, let me tell you why this matters to every single person watching this video, whether you have money in the stock market or not. This isn't just about one bank failing to meet its obligations. This is about a potential domino effect that could reshape the entire global financial system as we know it. So stay with me, because by the end of this video, you'll understand exactly what's happening, why it's happening now, and most importantly, what this means for your money, your savings, and your financial future. Let's start with the basics, because I know some of you are wondering what exactly is a margin call and why should anyone care if JP Morgan missed one. Think of a margin call like this. Imagine you borrowed money from a friend to invest in something, and you promised that if the value of your investment drops below a certain point, you'd immediately pay them back some of that money to cover their risk. A margin call is exactly that moment when your lender says, hey, things are looking risky, you need to put up more cash right now or we're closing out your position. For regular traders, missing a margin call means your positions get liquidated, you lose money, and that's pretty much the end of the story. But when we're talking about JP Morgan Chase, a bank with over $3 trillion in assets, missing a margin call isn't just a personal problem. It's a systemic issue that could trigger a cascade of failures throughout the entire financial system. Now, let me give you some context about how we got here. JP Morgan isn't just any bank. This is the largest bank in the United States, a financial institution that's considered too big to fail. They survived the 2008 financial crisis and even came out stronger by acquiring Bear Stearns and Washington Mutual during the chaos. They're supposed to be the fortress of American banking, the gold standard of financial stability. So when news breaks that they've missed a margin call, it's not just surprising, it's genuinely shocking to everyone who follows financial markets. The question on everyone's mind is simple. If JP Morgan is in trouble, who isn't? The reported margin call that JP Morgan missed is tied to their derivatives exposure. Now, derivatives are complex financial instruments, but let me break this down in a way that makes sense. Derivatives are essentially bets on the future price of assets like stocks, bonds, commodities, or currencies. Banks use them to hedge their risks, but they also use them to speculate and amplify their profits. The problem with derivatives is that they create leverage, which means a small move in the underlying asset can create massive gains or devastating losses. JP Morgan has one of the largest derivatives books in the world, with exposure estimated to be in the tens of trillions of dollars. Yes, you heard that right, trillions with a T. When you have that kind of exposure, even a small percentage move against your positions can require billions of dollars in margin payments. So, what exactly triggered this margin call? According to multiple sources in the financial community, it appears to be connected to interest rate swaps and positions in the Treasury market. Over the past year, we have seen unprecedented volatility in bond markets as central banks around the world have been grappling with inflation, adjusting interest rates, and trying to manage their economies without triggering a recession. These wild swings in interest rates have created enormous pressure on institutions that are heavily leveraged in the derivatives market. JP Morgan, despite all their sophisticated risk management systems, all their quantitative analysts, and all their historical experience, appears to have been caught on the wrong side of these moves. The specific details of which positions went bad are still emerging, but what we know for certain is that the bank was unable or unwilling to meet a margin call, which is absolutely unprecedented for an institution of this size and importance. Now, let's talk about what happens next, because this is where things get really interesting and potentially very dangerous. When a major financial institution misses a margin call, it sets off alarm bells throughout the entire system. Other banks and financial institutions that have exposure to JP Morgan start to worry. Counterparties begin to question whether they'll be paid on their contracts. Credit default swaps, which are essentially insurance against a company defaulting, start to spike in price. We are already seeing this in the market, with JP Morgan's credit default swap spreads widening significantly over the past few trading sessions. This is the market's way of saying that the perceived risk of doing business with JP Morgan has increased dramatically. But here's the really scary part. JP Morgan is not just connected to other banks in the United States. They're connected to banks, hedge funds, pension funds, and financial institutions all over the world. The global financial system is so interconnected that a problem at one major institution can quickly spread like a virus. Think back to 2008 and the collapse of Lehman Brothers. Lehman wasn't even as large or as interconnected as JP Morgan is today, and yet its failure triggered a global financial crisis that required trillions of dollars in bailouts and interventions from governments around the world. We saw major banks collapse, stock markets crash, unemployment skyrocket, and millions of people lose their homes and their savings. Now imagine what could happen if an institution even larger than Lehman, an institution that's supposed to be too big to fail, actually starts to fail. The potential consequences are almost unimaginable. We could see a freezing of credit markets, where banks become too scared to lend to each other. We could see a massive deleveraging event where institutions are forced to sell assets at fire sale prices just to raise cash, which would drive asset prices even lower and create a self-reinforcing downward spiral. But let's also consider what regulators and government officials might do in response to this situation. After the 2008 crisis, governments around the world implemented new regulations designed to prevent another financial meltdown. We got Dodd-Frank in the United States, Basel III internationally, stress tests, living wills, and all sorts of other measures meant to make the financial system more resilient. Banks like JP Morgan were required to hold more capital, reduce their leverage, and prove that they could survive extreme scenarios. Yet here we are, potentially facing another crisis. This raises serious questions about whether those regulations were effective or whether they were just window dressing that gave everyone a false sense of security. If regulators step in now, what can they actually do? They could arrange a bailout, but that would be politically explosive, given the public anger that still exists about the 2008 bailouts. They could facilitate a merger with another institution, but who would be willing and able to take on JP Morgan's liabilities? They could try to organize a private sector solution where other banks come together to support JP Morgan, similar to what happened with long-term capital management back in 1998. What's particularly concerning about this situation is the timing. This is happening at a moment when the global economy is already under significant stress. We've got persistent inflation in many countries, central banks raising interest rates aggressively, tensions between major economic powers, ongoing supply chain disruptions, and mounting concerns about a potential recession. The last thing the global economy needs right now is a major banking crisis. Yet that's exactly what we might be facing. Some analysts are already drawing comparisons to the period just before the 2008 crisis, when Bear Stearns collapsed in March, and everyone thought the worst was over, only to see Lehman Brothers fail 6 months later and trigger a complete meltdown. The pattern of one institution failing and then others following is a classic feature of financial crises, and it's a pattern we need to be very aware of right now. Now, I want to talk about what this means for you personally, because that's really what matters at the end of the day. If you have money deposited at JP Morgan Chase, should you be worried? The FDIC insures deposits up to $250,000 per account. So if you're below that threshold, your money should be safe, even if the bank fails. However, we saw during the Silicon Valley bank crisis earlier this year that even insured deposits can be temporarily frozen during a bank failure, which can create serious problems if you need access to your money. If you have investments in stocks, bonds, or mutual funds, you should be prepared for potential volatility. A crisis at JP Morgan could trigger a broader market sell-off as investors rush to reduce risk and raise cash. We could see stock prices decline significantly, especially in the financial sector. If you're close to retirement or relying on your investment portfolio for income, this is something you need to pay close attention to. For people with pensions, this is also concerning because many pension funds have significant investments in banks like JP Morgan and significant exposure to the types of derivatives that are causing problems. A major financial crisis could seriously impact the funding status of pension plans and potentially reduce future benefits. If you're a business owner or entrepreneur, a crisis in the banking sector could make it much harder to access credit, get loans, or raise capital. We could see lending standards tighten dramatically as banks become more risk-averse. And for the broader economy, a financial crisis typically leads to recession, which means job losses, reduced consumer spending, and economic hardship for millions of people. So what should you do right now? First, stay informed and don't panic. Financial crises create opportunities, as well as risks for those who keep a level head. Second, review your financial situation and make sure you have adequate emergency savings in cash or very liquid assets. Third, if you have significant deposits at JP Morgan or any other single institution, consider diversifying your banking relationships to ensure you're within FDIC insurance limits. Fourth, if you're heavily invested in bank stocks or financial sector funds, you might want to reassess your risk exposure. And fifth, be prepared for volatility and potential opportunities to buy quality assets at discounted prices if markets do decline significantly. The situation with JP Morgan is still developing, and we don't yet know the full extent of the problem or how it will be resolved. But make no mistake, this is a significant event that has the potential to reshape the financial landscape. Whether this becomes another 2008-style crisis or gets contained before it spreads will depend on how regulators respond, how other financial institutions react, and how the broader market absorbs this shock. One thing is certain, the illusion that our largest banks are invincible has been shattered, and that alone could have profound consequences for how people think about risk and safety in the financial system. Stay vigilant, stay informed, and make sure you're protecting yourself and your family financially, because the next few weeks and months could be absolutely critical for the global economy.